Hello everyone, the stock market had a monster rally last week. It was one of the best weeks in the history as so many stocks went up by more than 10% in one week, something that is extremely uncommon. To add on, the US dollar, which usually moves in opposite direction of the stock market, plummeted, suffering its worst weekly loss in years. So, is the bear market over? Let's dive in deeper in this video. Do also stay on to the end as I share my thoughts on the current rally and what investors can consider doing. So last Thursday, the US stock market recorded one of the best sessions since the early days of the pandemic in 2020. This is likely due to the reported inflation number was weaker than expected, at 7.7% versus the expectations of 8.0%. Some investors see this as a potential game changer as it reignited hopes that Fed may pause or slow down the interest rate hikes. And in case you are not aware, the Fed has implemented 4 consecutive rate hikes of 75 basis points, and together with Fed, analysts and investors are also monitoring closely for signs that these rate hikes have worked. Right now, given the slightly lower inflation number, many analysts are expecting the Fed to slow down the pace of its aggressive rate hikes with a lower than 75 basis points in the next FOMC meeting. It could well be 50 or maybe even 25 basis points. Outside of US, there was also good news as China eased COVID restrictions on Friday, thus providing further boost to the stock market. With the latest monster rally, some investors have started to wonder if the bear market is over. But before we talk about that, let's understand what Fed may be doing in the upcoming months. As you know, the stock market of 2022 has been pretty much driven by Fed and their interest rate hikes vis-a-vis inflation. Earlier on, Jerome Powell has already mentioned that he needs to see a multi-month trend of cooling inflation numbers before shifting his monetary policy. This, in my opinion, means that we could get a lower interest rate hike in the next FOMC meeting. But however, a complete halt or pivot by the Fed is quite unlikely until we see the inflation numbers go down for a few months. Therefore, watch out for the next CPI number and also pay attention to what Jerome Powell has to say in the next FOMC meeting, which is scheduled to take place on December 13 and 14. With all being said, at this point, investor sentiment seems to have improved, and if you add in the seasonality rally that we usually have during this period, the stock market has considerable upside potential into year-end after the recent so-called game changer CPI report. Okay, as usual, let's start the technical segment off with SPY, which represents the broad market. If you guys have been following me, you probably know I shared on a few occasions that 385 to 389 zone is crucial. Once broken, there is high probability that we could fly towards 400. And guess what? We kissed 399 on Friday. We are almost there. And then in my very last video, I also shared that there is this dragonfly doji candlestick. And if last Monday's closing price is above 378.8, the short-term trend is bullish. And there you are, SPY rallied hard last week. Anyway, despite the current bullish run, there are 3 things worth highlighting. Number 1, we have a huge gap up. And as they say, gaps are filled 90% of the time. Not saying this time it will or will not be filled, but just laying out the probability for investors to think about. The second thing that is noteworthy is that SPY closed right at the smack of the 61.8 Fibonacci retracement level at 398, and this level is usually a crucial one in Fibonacci retracement context. And the third thing that I wish to highlight is that we are approaching the 200 moving average, which currently sits at 404. This again is a crucial moving average among all moving averages, and it usually poses as a huge resistance. To add on to this particular point, check out what happened the last 2 times when SPY tested the 200 moving average. We had a massive slide down. Again, not predicting that it will happen, but just laying out some facts in case viewers are not aware. In my view, we can expect heavy resistance at around 400 to 406, because this is where a huge gap, the 200 moving average, and the 400 psychological level are. Given all these key levels all consolidating at one area, if SPY can break above it, I think we could fly as high as 413. However, if sellers start stepping in and SPY gets rejected, we should be able to find some support at 389. Below that, we have a little gap between 381 to 385 pending to be filled, after which there is strong support at around 377 to 379, as there is where the 50 moving average and 38.2 Fibonacci level are. My personal view is that the probability of SPY going below this level is low from now till the next FOMC meeting on 13 and 14 December. Again, I could be wrong. Before I move on to Apple, just a small little request, that is, please help me with the YouTube algorithm by hitting the like and subscribe buttons if you have not done so. I hope my channel can garner more likes and subscriptions as I wish to reach out to more viewers. Okay, let's talk about Apple. Last week, I shared that I found the chart particularly interesting because as much as it looks bearish, we could still potentially form a mini double bottom here, which is a bullish sign, and we could have a bounce. I then also highlighted one key level, which is 144. I went on saying if we can break and close above 144, then Apple could fly to 149 to 150. And look at where we are now, 149. I hope all this analysis deserve a hit on the like and subscribe buttons, please. Alright, looking ahead, watch out for resistance at around 150. To me, this is not a strong resistance, and given that MACD just curled up, which is a bullish sign, we could just go all the way up to 155 where a bigger resistance is. Namely because there is where the 200 moving average and 50% Fibonacci retracement level are. And if Apple can break above 155, we can fly further to 160. All in all, in terms of the upside, my view, just my personal view alright, is that the probability of hitting 155 soon is high, as both MACD and RSI still have room to go up. On the downside, support at 147, aka the 50 moving average, followed by 144. If 144 breaks, I think we can expect to fill that gap between 138 and 139. And 138 is another support which seems to be a strong one at the moment. I am not expecting Apple to break below this from now till the next FOMC meeting. Again, I could be wrong. Now let's have a look at Tesla. Amongst all the mega cap stocks, Tesla was the weakest last week. Anyway, do you recall I highlighted the potential bear flag on the technical chart, and I compare it against Google's bear flag and highlighted that once the bear flag is formed, the downside can be massive. I also shared that we could break the recent low of 198. There we have it, Tesla created a new 52-week low of 177. Okay, here's something very interesting. Check out last Thursday's candlestick. Does it look familiar? It's similar to the one I shared for SPY, a dragonfly candlestick, which is a bullish sign. And for confirmation, the next candlestick needs to close above the previous day's high, aka 195, which Tesla did on Friday as it closed at 195. Therefore, the short-term trend looks bullish now. We could be on our way up to test the first Fibonacci retracement level at 209. In fact, to be more cautious, watch out for the psychological level of 200 too. If Tesla can break free from 200 to 209 zone, we could just fly towards 229 or 230 where the next resistance level is. That's more than 20 points of upside. But a huge caveat here, Tesla, as we all know, it's super volatile and is especially unpredictable with Elon and its Twitter deal. So I think it's good to be mentally prepared for the downside. Watch out for 175 to 177. Once this area breaks, there is little support all the way to 150's range. Again, nothing is guaranteed, it's all about probability. Okay, finally we have Google. Google seems to be recovering from the bear flag. The only thing that I don't like about this rally by Google is that it created two gaps on its way up. One small one at around 86 and one big one between 89 and 91. We may come back down to fill them someday, but I don't know when. However, at this point, the trend looks bullish with MACD curling up. That being said, do expect heavy resistance between 98 and 102 for three reasons. Number one, that is where the big gap lies. So if Google were to go up to fill this gap, we can expect some sellers stepping in. Second reason, 100 has always been a psychological level for both up and downside. And the third reason is that we will be entering the Ichimoku cloud at around 101. So let's say if we break above this range of 98 to 102, there is actually one more huge resistance at 105. It seems like there are quite a fair bit of heavy resistance, huh? Well, I will be watching the price action very closely as I am planning to sell covered calls, which is a bearish move. And of course, I would want to sell the covered call with decent premiums. To sum up this video, I just wanted to highlight that the latest inflation report is a good reading and encouraging. But 7.7 inflation is still a high number. This elevated inflation figure will likely remain for a while. And more importantly, we are still very far from hitting what the Fed wants to achieve, which is around 2%. To add on, investors should not rely too much only on one data point. I mean, the Fed has repeatedly mentioned that the fight against inflation is a long process, and 1 month worth of data is not conclusive. And in case you have short-term memory, inflation data has given us false hope this year, where it dropped for a month and then rose again. Therefore, don't get too excited about the latest monster rally. Such huge rally is not uncommon in the bear market, and that is why I would want to caution investors to be careful when chasing this rally. To me, the rally could go on till the end of this month or even end December for a center rally, but I am still not convinced at this point that the bear market is already over. Simply because the fact is, inflation is still sticky, rates are still high, big tech firms are firing people, and all these are pointing towards a 2023 recession. Or some may even say that we are already in one. Don't forget, Fed's monetary policy operates with a big lag. This means while the economy may look relatively strong at the moment, we will never know what's the real impact of aggressive rate hikes on the economy in 2023. We also wouldn't know if the market has even priced in the potential impact. With all these headwinds, I wouldn't be surprised if we have a rug pull or reversal to the downside again. With all being said, I don't have a crystal ball, so I could be totally wrong. Hence, going back to what I have always preached, that is to dip your toes into the stock market periodically, just like how I have been picking up shares in the last 2 months. So even if this rally is a new bull run, I am still able to participate in the uptrend. So what if you haven't been buying stocks? Not financial advice, but I think it's still not too late. In my view, the current rally is too fierce for my liking with so many gap up, and therefore I am expecting some form of meaningful pullback soon, simply because it is not possible for the market to go up without any retracements or pauses. Alright, that's all for this video. What are your thoughts on the latest rally? Let me know in the comment section below. Would love to hear them. And lastly, if you found my videos useful, please help to hit the like and subscribe buttons. Thank you.